There's a multi-trillion-dollar industry built on a single seductive lie. It's a lie whispered on every financial news network, screamed from the headlines of every market commentary website, and sold in the glossy brochures of the world's most expensive wealth management firms. The lie is that the future can be known, that with enough data, enough intelligence, enough sophisticated modeling, someone, somewhere, can tell you what the stock market will do tomorrow, what interest rates will be next year, or whether a recession is lurking just around the corner. They sell predictions, they sell forecasts, they sell the intoxicating illusion of certainty in a world that is fundamentally and permanently uncertain. And then there is Warren Buffett, a man who has built an empire of hundreds of billions of dollars, not by mastering the art of prediction, but by mastering the art of ignoring it. He has become one of the wealthiest human beings in history by operating on a profound and deeply counterintuitive truth. The future is not knowable, and any attempt to predict it is not just a waste of time, it is a dangerous and financially suicidal endeavor. His entire investment philosophy, his approach to business strategy, and the very structure of his legendary company Berkshire Hathaway is a direct, living refutation of that entire multi-trillion-dollar industry. He doesn't try to predict the rain, he builds an ark. This is not a guide to a new stock tip or a clever market timing strategy. This is an inoculation. It is a mental vaccine against the plague of forecasting and the anxiety it creates. We are going to deconstruct the operating system of Buffett's mind, a system designed not to outguess the future, but to build a financial fortress so strong, so robust, so resilient, that it is engineered to succeed regardless of what the future holds. We will explore the 5 pillars of this anti-forecasting philosophy, the foundational principles that separate the enduring success of the professional from the frantic guesswork of the amateur. This is your liberation from the noise machine. This is the blueprint for building an unsinkable ship in a world of endless storms. This is Warren Buffett's guide to ignoring the future, and in doing so, securing your own. Our journey begins with the most fundamental pillar of all, the bedrock upon which his entire empire is built. It's a concept so simple it sounds almost trivial, yet it is the single most powerful defense against the siren song of prediction. It is the discipline of knowing what you don't know, a principle he calls the circle of competence. To the outside world, it looked like stubbornness, like an old man who had lost his touch. But to Buffett, it was the only rational response to a world gone mad with speculation. It was the ultimate act of risk management. The year is 1999. The world is in a frenzy. The internet, a once obscure technology, has captured the global imagination, and with it, the global financial markets. It was the era of the dot-com bubble, a time when any company with a .com at the end of its name, regardless of its business model, its revenue, or even its product, could see its stock price multiply by 10, 20, or 100 times in a matter of months. Financial television was a 24-hour highlight reel of fresh-faced tech CEOs becoming billionaires overnight. Market prediction experts, armed with new metrics like eyeballs and, quote, click-through rates, declared that the old rules of investing were dead. This time, they insisted, was different. And in the middle of this speculative mania sat Warren Buffett in Omaha, Nebraska, doing nothing. As the NASDAQ Composite Index soared past 3,000, then 4,000, then 5,000, Berkshire Hathaway, his legendary investment vehicle, was trailing the market badly. The financial press, once fawning over his every move, turned on him with a vengeance. The influential magazine Barron's published a cover story in December 1999 with a portrait of a pensive-looking Buffett and a brutal, dismissive headline, "What's wrong, Warren?" The article was scathing. It portrayed him as a relic, a man whose old-fashioned ideas about profits and value were hopelessly out of date in the new digital economy. He was criticized for failing to invest in the technology stocks that were making everyone else rich. He was mocked for his Luddite ways, for admitting he didn't even have a computer on his desk. The pressure was immense. His own shareholders were questioning him. the world's most celebrated investor was being publicly ridiculed as a has-been. But Buffett's refusal to dive into the tech frenzy was not born of ignorance or stubbornness. It was a calculated act of intellectual humility. In his shareholder letters and at his annual meetings, he explained his reasoning with startling clarity. He didn't have a crystal ball telling him that these stocks would crash. He simply stated that he did not understand them. He could not, with any degree of certainty, project what the competitive landscape or the cash flows of a company, like Pets.com or Webvan, would look like in 10 or 20 years. He understood Coca-Cola, he understood Gillette, he understood the insurance business. He knew how people would be drinking soda and shaving their faces a decade from now. But he had no special insight into which search engine would dominate, which online retailer would survive, or which fiber optic cable company had a durable competitive advantage. These businesses were, in his own words, outside his circle of competence. He wasn't making a market prediction that the bubble would burst. He was making a personal admission that he was not equipped to play in that particular sandbox. It was a simple, powerful declaration. I don't know. In a world where every financial expert claimed to know exactly what the future held, Buffett's greatest strength was admitting his own ignorance. He was willing to look foolish in the short term to avoid being wiped out in the long term. And then, the future arrived. In March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, began a catastrophic collapse. Over the next 2 years, it would fall nearly 80%. Companies that were once worth billions went bankrupt. The new paradigm was revealed to be the same old speculative mania, dressed in digital clothes. Trillions of dollars of paper wealth vanished. And while the world burned, Berkshire Hathaway, with its portfolio of old economy businesses and its massive pile of cash, was not just safe, it was ready. The discipline of staying within his circle of competence had not only protected him from the crash, it had armed him with the capital to take advantage of the bargains that emerged from the wreckage. The world had tried to sell him a prediction about the future of technology, and he had wisely chosen to trust what he knew about the past of human behavior. This steadfast refusal to gamble outside his intellectual territory is not just a personal quirk, it's a powerful antidote to one of the most pervasive and dangerous psychological traps in human decision-making, the Dunning-Kruger effect. This cognitive bias, identified by psychologists David Dunning and Justin Kruger, describes a phenomenon where people with low ability in a specific domain systematically overestimate their own competence. In simple terms, they are too ignorant to recognize their own ignorance. The financial world is a petri dish for the Dunning-Kruger effect. The sheer volume of information, the constant stream of breaking news, and the illusion of control created by online trading platforms give many amateur and even professional investors a dangerously inflated sense of their own expertise. They read a few articles about cryptocurrencies or artificial intelligence and suddenly believe they are qualified to make multi-thousand-dollar bets on their future, a classic failure of risk management. When an investor hears a market prediction on television, the Fed is going to cut rates, so tech stocks are a buy, it feels like actionable intelligence. Their brain craves certainty and a simple cause and effect narrative. They mistake familiarity with a topic for genuine understanding. This is compounded by another cognitive flaw, overconfidence bias. We are all, to some degree, wired to be overly optimistic about our own judgments. We believe we are better than average drivers, have a better-than-average sense of humor and, most perilously, a better-than-average ability to pick winning stocks. This overconfidence leads us to take on far more risk than is prudent, especially in areas where our knowledge is shallow. Warren Buffett's concept of the circle of competence is a behavioral finance tool designed to build a fortress against these biases. It is a conscious, deliberate act of drawing a line in the sand. On one side of the line are the businesses and industries you understand deeply, almost instinctively. On the other side is everything else, the vast, unknowable universe of things you don't understand. The critical rule of the game is to never, ever step over that line, no matter how tempting the party on the other side looks. It's a system that forces humility. It replaces the arrogant question, "Could this make me rich?" with the humble question, "Do I truly understand this?" By defining the boundaries of his knowledge, Buffett avoids the Dunning-Kruger trap entirely. He doesn't have to worry about being overconfident in an area where he has no expertise, because he has already declared that area off limits. This is not about limiting your opportunities. It is about protecting yourself from your own worst psychological instincts. It's an acknowledgement that in the complex game of long-term investing, self-awareness is a far more valuable asset than a high IQ or a sophisticated forecasting model. So how can you translate this profound psychological insight into a practical tool for your own financial planning and business strategy? The first step in building your own circle of competence is to apply the explain it to a child test. Take any potential investment or business venture. Can you explain in simple, direct language how it makes money? Can you describe its product or service, who its customers are, and why they choose this company over its competitors? And crucially, can you articulate why it will still be making money 10 years from now? If your explanation requires complex jargon, industry buzzwords, or vague references to disruptive technology, it is a blaring red flag that this idea lies outside your circle. A true expert can distill complexity into simplicity. If you can't, you're not an expert. This simple test would have saved millions of investors from the dot-com bust. No one could have simply explained how a company like eToys, which was valued at nearly $8 billion, had a sustainable path to profitability. The second step is the process of the deep dive. Competence is not acquired by reading headlines or watching a 5-minute news segment. It is built through diligent, focused work. Choose an industry that genuinely interests you. It could be retail, banking, software, or manufacturing. Then, commit to becoming a genuine expert. This means going far beyond the stock price. Read the last 10 years of annual reports for the top 3 companies in that sector. Read their quarterly earnings call transcripts. Read trade journals specific to that industry to understand its unique challenges and opportunities. Talk to people who work in the industry. Talk to their customers. Try their products. The goal is to understand the business from the inside out, to grasp its fundamental economics so thoroughly that you could give a lecture on it. This deep knowledge is what gives you the conviction to act when others are panicking, a key element of the CEO mindset. Finally, and perhaps most importantly, you must create what Charlie Munger, Buffett's longtime business partner, calls the too hard pile. This is a mental or even a physical pile where you place the vast majority of investment ideas and business opportunities that come your way. Your default answer to any new idea should not be yes or no, but is this inside my circle? For 99% of things, the answer will be a swift and definitive placement into the too hard pile. This isn't a sign of failure, it is the hallmark of a disciplined mind. It's the filter that protects your capital and your focus for the rare, truly great opportunities that you genuinely understand. Building this pile requires shedding your ego. You have to be comfortable saying, "I don't know," and "I don't understand," far more often than you say, "I'll buy." This discipline is the very essence of a sound investment philosophy. To truly appreciate the power of this discipline, we must examine its opposite, the path of the 99%. This is the path of the investor who operates with no circle of competence, who is guided only by the shifting winds of market sentiment and expert predictions. Consider the average investor during that same dot-com bubble. Their journey began with a tantalizing story. They heard from a friend or saw on TV that people were getting rich quick. They didn't understand the technology, the business models, or the valuation metrics, but they understood one thing: the price of these stocks was going up. This is the first and most critical mistake: substituting price momentum for genuine understanding. This investor, driven by the fear of missing out, opened a brokerage account. They didn't look for businesses with a long history of profitability or a durable competitive advantage. They looked for ticker symbols attached to exciting stories. They bought shares in companies like theglobe.com, a social networking precursor that went public and soared over 600% on its first day of trading, despite having negligible revenue. They bought into Cosmo.com, which promised one-hour delivery of snacks and movies, a logistical nightmare with no hope of profitability. They were not investing in businesses, they were buying lottery tickets. Their research consisted of reading anonymous tips on internet message boards and listening to pundits on financial television who confirmed their biases. They ignored traditional valuation metrics like the price-to-earnings ratio because they were told, this time it's different. They were operating in a state of complete ignorance, masquerading as sophisticated participation in a new economy. When the crash came, they were utterly unprepared. They had no anchor of intrinsic value to hold on to, no deep understanding of the businesses to give them conviction. All they knew was that the price was falling, and the same experts who told them to buy were now screaming sell. They panicked, sold their holdings near the bottom, and locked in devastating, life-altering losses. This is the inevitable fate of those who wander outside the circle of competence. They become emotional puppets, their financial destiny controlled by the manic-depressive mood swings of the market, forever chasing the last hot trend and paying the ultimate price for their lack of intellectual discipline. The direct financial connection of this principle is stark and quantifiable. It manifests most clearly on the balance sheet of Berkshire Hathaway in the year 2000. While the tech-heavy Nasdaq was in freefall, erasing trillions in market capitalization, Berkshire's balance sheet was a fortress of stability and burgeoning power. Buffett's refusal to participate in the mania meant that his company was not suffering from the massive write-downs and asset impairments that plagued so many others. More importantly, his discipline had preserved his most valuable asset, cash. As other investors were forced to sell good assets to cover their losses on bad speculations, Buffett was sitting on a mountain of liquidity. This cash wasn't just a defensive measure, it was dry powder, a strategic weapon. In the years following the crash, a landscape of corporate carnage, Buffett was able to deploy that capital with devastating effectiveness. He could buy businesses and securities at fractions of their true worth from desperate sellers. His inaction during the boom directly translated into immense purchasing power during the bust. His circle of competence wasn't just a philosophical idea, it was a financial mechanism that converted the market's folly into his opportunity. The difference between a portfolio decimated by the crash and a balance sheet ready to pounce on the resulting bargains is the direct, multi-billion-dollar financial consequence of knowing what you don't know. It is the first and most crucial step in building a fortune that can withstand any future. Once you have defined the boundaries of your knowledge, you are faced with a new challenge. Within that circle of competence, how do you decide what something is truly worth? This leads us to the second pillar of Buffett's anti-forecasting philosophy, a concept that provides a steadfast anchor in the chaotic sea of market fluctuations. It is the profound distinction between price and value. As Buffett famously says, price is what you pay, value is what you get. The entire industry of market prediction is obsessed with price, where it's going, how fast it will get there, what the chart patterns suggest. Buffett ignores this noise almost completely. Instead, he focuses with monastic intensity on calculating the intrinsic value of a business, the underlying worth of the enterprise, completely independent of its daily stock market quotation. To understand this principle in action, we must travel back to 1973. It was a dark time for the American economy and the stock market. The Nifty 50 bubble, a period where investors believed you could pay any price for a group of 50 large, fast-growing companies, had just burst. The market was in a brutal bear market, down nearly 50% from its highs. The Vietnam War was raging, the Watergate scandal was consuming Washington, and an oil crisis was crippling the nation. Economic forecasting was universally bleak. The consensus was that things were bad and likely to get worse. In this environment of deep pessimism, the stock of the Washington Post Company had been obliterated. The company, a respected but not yet dominant media institution, saw its market capitalization shrink from over $170 million to a mere $80 million. The market, in its infinite wisdom, was screaming that the company's future was dim. This is where Warren Buffett saw not a crisis, but an opportunity. While other investors were panic selling based on the gloomy economic predictions and the falling stock price, Buffett did something entirely different. He sat down and began to analyze the business of the Washington Post. He ignored the stock quote, the ticker tape, the noise. He asked a simple question: what is this enterprise actually worth? He saw a company that had a near monopoly on the news in the nation's capital, a powerful and durable competitive advantage. He saw a brand that was synonymous with journalistic integrity, especially as its reporters Woodward and Bernstein were breaking the Watergate story. He analyzed its circulation, its advertising rates, its television station assets. He did a thorough, bottoms-up valuation and came to a stunning conclusion. In his conservative estimation, the entire Washington Post company was worth at least $400 million and perhaps as much as $500 million. And yet, the stock market, in a fit of depression, was offering to sell it to him for just $80 million. He was being offered $1 of real, tangible business value for just 20 cents. He began buying stock aggressively, eventually investing over $10 million and becoming a major shareholder and a board member, forging a lifelong friendship with its leader, Katharine Graham. Over the next decade, that investment would multiply more than 100-fold, becoming one of the cornerstones of the Berkshire Hathaway empire. This legendary success had absolutely nothing to do with predicting the economy or the stock market. It was the simple, powerful act of calculating a business's true worth and buying it for far, far less. The psychological principle underpinning this approach is a direct counterattack on a powerful cognitive bias known as anchoring. In the absence of better information, our brains tend to latch onto the first piece of information we receive, the anchor, and we adjust our subsequent judgments based on that starting point. In financial markets, the most prominent anchor is the current stock price. When an investor sees a stock trading at $50, their perception of its value is immediately anchored to that number. If it drops to $45, they perceive it as cheaper, and if it rises to $55, they see it as more expensive. Their entire framework for value is dictated by the market's latest whim. Buffett's genius lies in his ability to willfully ignore this anchor. He creates his own anchor, his meticulously calculated estimate of intrinsic value. This self-generated anchor acts as a gravitational center for his decision-making. The market's price then becomes just one piece of data, to be compared against his anchor of value. This mental discipline is beautifully illustrated by his teacher Benjamin Graham's famous allegory of Mr. Market. Graham asked his students to imagine they were business partners with a man named Mr. Market. Every day, Mr. Market shows up and offers to either buy your shares or sell you his, at a specific price. The catch is that Mr. Market is a manic depressive. Some days he is euphoric, sees only a rosy future, and offers to buy your shares at ridiculously high prices. On other days he is inconsolably pessimistic, sees nothing but ruin ahead, and offers to sell you his shares at absurdly low prices. Graham's point is that a sane person would not let Mr. Market's mood swings dictate their own view of the business's value. You wouldn't sell out to him when he's euphoric, nor would you be panicked into selling just because he is depressed. You would happily sell to him when his price is high, and happily buy from him when his price is low, all the while guided by your own independent judgment of the business's true worth. The 99% of investors let Mr. Market's daily quotes become their reality. They are his emotional servants. Buffett's approach is to treat Mr. Market as a useful but emotionally unstable servant from whom he can occasionally profit. This is the core of behavioral finance in practice. Translating this into an applied mental model, a blueprint for your own investing or entrepreneurship, requires a shift in focus from the external to the internal. The first step is to learn the language of value, starting with what Buffett calls owner earnings. This is his preferred metric for understanding the true cash-generating power of a business. It starts with a company's reported net income, then adds back non-cash charges like depreciation and amortization, and finally, subtracts the average amount of capital expenditures required to maintain the business's competitive position. The resulting number is a much more honest picture of the cash that an owner could theoretically pocket at the end of the year. Learning to calculate this, even with a back-of-the-envelope estimation, forces you to think like a business owner, not a stock trader. The second, more advanced step is to grasp the logic of a discounted cash flow (DCF) analysis. This sounds intimidating, but the concept is simple. The value of any business is the sum of all the cash it will generate from now until Judgment Day, discounted back to its present value. You don't need a complex spreadsheet with dozens of variables. The mental exercise is what matters. You must ask, how much cash is this business likely to produce over the next 5 or 10 years? How certain am I about that projection? And what is that future stream of cash worth to me today? This process forces you to think critically about the long-term durability of the business, its growth prospects, and its risks. It shifts your focus away from, will the stock go up next month, to, is this a wonderful economic engine that will produce cash for years to come? A third valuation lens is the asset-based approach. For some businesses, particularly those in crisis, you can ask, what are the component parts of this business worth if they were sold off separately? This could include real estate, inventory, brand names, or customer lists. Sometimes, the market price of a company can fall so low that it is worth less than its tangible assets. This provides a hard floor for your valuation and a clear opportunity for the discerning analyst. Mastering these simple valuation frameworks is the key to creating your own intellectual anchor, liberating you from the emotional tyranny of market prices and the meaningless noise of economic forecasting. It's a fundamental skill for effective portfolio management. The antithesis to this disciplined, value-based approach is the world of the day trader and the momentum investor, the path walked by the 99%. This individual's universe is entirely confined to the screen. Their reality is the chart, the price pattern, the 50-day moving average. They have little to no interest in the underlying business. They wouldn't know the company's CEO if they sat next to them on a plane. They haven't read the annual report. They cannot calculate owner earnings. Their entire strategy is based on predicting the short-term psychological reactions of other equally uninformed market participants. They are not just listening to Mr. Market. They are trying to psychoanalyze his every twitch. A perfect modern example of this is the meme stock phenomenon. During the frenzy around companies like GameStop and AMC, the stock price became completely untethered from any rational assessment of intrinsic value. The businesses themselves were struggling, with declining revenues and uncertain futures. Yet, their stock prices soared to astronomical levels, driven by social media hype and a desire to squeeze institutional short sellers. People were buying not because they had done a DCF analysis, but because they saw a rocket emoji on a Reddit forum. The price was the only thing that mattered. It was a pure, unadulterated game of musical chairs. For the few who got out in time, the profits were immense. But for the vast majority who bought in near the top, entranced by the rising price and the illusion of a new financial paradigm, the losses were swift and brutal. They learned the hard way that a high price is not the same as a high value. They were the ultimate victims of anchoring, their perceptions chained to a price that had no connection to economic reality. This is the predictable outcome when you substitute speculation on price movements for the diligent work of business valuation. The direct financial connection of this principle is the very source of an investor's profit and safety. The gap between a business's intrinsic value and its market price is what Buffett calls the margin of safety, a concept so important it forms the next pillar of his philosophy. When you buy a business worth $1 for 50 cents, you have created a powerful financial advantage. First, your potential return is enormous. If the market simply comes to recognize the true value of the business, you have a 100% gain. Second, you have built in a massive cushion for error. Your valuation could be off. The business might face unexpected headwinds. A recession might hit. But because you bought with such a large discount, a lot of things can go wrong before you actually lose your principal. The financial statement impact is clear. Your risk of a permanent capital loss is dramatically reduced. In contrast, the person who buys $1 of value for $2, caught up in a popular trend, has a return profile that is the mirror opposite. They need everything to go perfectly just to break even, and any slight stumble in the business or the economy can lead to a catastrophic loss. The discipline of anchoring to value and ignoring price is not just an intellectual exercise, it is the mathematical engine of wealth building and the strongest shield in your risk management arsenal. Even with a defined circle of competence and a firm anchor in intrinsic value, you are still operating in an unpredictable world. You might be wrong. Your calculations could be flawed. The future, as we have established, is unknowable and can deliver shocks that no one sees coming, so-called black swan events. This is why the third pillar of Buffett's system is perhaps the most critical for long-term survival. It is the engineering principle that makes his financial fortress truly unsinkable. The margin of safety. This isn't just about buying things cheap. It's a comprehensive philosophy of building a buffer for error into every single decision, acknowledging that forecasts will be wrong and that you must be prepared for it. The year is 1963, and a bizarre corporate disaster is unfolding, known as the Salad Oil Scandal. A small, insignificant subsidiary of the mighty American Express had made a catastrophic error. It ran a warehousing division that issued receipts for stored goods, which other banks would then accept as collateral for loans. One of its biggest customers was a company called Allied Crude Vegetable Oil. As it turned out, Allied's giant storage tanks, which were supposed to be full of valuable salad oil, were mostly full of seawater, with only a thin layer of oil floating on top. When the fraud was discovered, Allied went bankrupt, and the banks holding the worthless warehouse receipts came knocking on American Express's door, demanding payment on nearly $60 million in defaulted loans, a massive sum at the time. Wall Street panicked. Market prediction was swift and brutal. American Express, the venerable institution of travelers' checks and charge cards, was facing bankruptcy. The stock collapsed, losing over 50% of its value in a matter of weeks. The consensus view, the forecast from the experts, was that the liability was too large to handle and would destroy the company's reputation. This is where Warren Buffett, then a young, relatively unknown fund manager, saw not a reason to panic, but a reason to investigate. He refused to accept the market's catastrophic prediction at face value. He applied the principle of the margin of safety, which begins with deep, independent thinking. He didn't just look at the headlines, he did the grunt work. He went to restaurants and retail stores, he talked to merchants, he visited banks. He was trying to answer one crucial question. Was this salad oil scandal affecting the core, underlying businesses of American Express, the traveler's checks, and the charge card? What he discovered was that the fundamental business was completely unharmed. Customers were still using their cards. Travelers were still buying traveler's checks. The brand's value in the minds of consumers and merchants was intact. He concluded that the company's earning power was still enormous, and that it could easily handle the salad oil losses. The market, in its panic, was pricing the company for bankruptcy. Buffett, through his research, saw a temporary containable problem. He calculated that the business was worth around $65 per share, even after accounting for the scandal. The market was offering him shares for $35. This massive gap between value and price was his margin of safety. He invested 40% of his partnership's capital, a huge, concentrated bet, into American Express stock. The market's fear was his protection. Over the next few years, as the company weathered the scandal and its true earning power became clear again, the stock soared, making a fortune for Buffett and his investors. He didn't predict the scandal would end. He built a position so cheap that it could withstand the uncertainty. The psychological force that Buffett was exploiting here is one of the most powerful and primitive biases in the human brain: loss aversion. Decades of research in behavioral finance, pioneered by Daniel Kahneman and Amos Tversky, have shown that the pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. When faced with negative news, like the salad oil scandal, our brains go into overdrive. The fear of loss triggers a cascade of catastrophic thinking. We extrapolate a single problem into total, irreversible ruin. This is the amygdala, our brain's ancient fear center, hijacking our more rational, prefrontal cortex. It's what causes investors to see a 10% market drop and immediately envision a second Great Depression, leading them to sell everything at the worst possible moment. The margin of safety is a pre-planned, rational defense system against this emotional hijack. It is a rule you set for yourself during times of calm that you must follow during times of storm. By demanding a significant discount to intrinsic value, you are essentially pre-committing to only act when the odds are overwhelmingly in your favor. This creates the emotional fortitude to be greedy when others are fearful. Because the price is so low and the buffer for error is so large, the fear of loss is dramatically diminished, allowing your rational brain to stay in control. It's a mental model that allows you to transform the market's panic from a source of personal terror into a source of immense opportunity, a core skill for any successful entrepreneurship. So how do you apply this powerful concept of a margin of safety to your own life, beyond just buying stocks? The first tool is the mental model of inversion, popularized by Buffett's partner Charlie Munger. Instead of asking, "How can I make this investment or business venture succeed?" you invert the question and ask, "What are all the ways this could fail?" Make a list. A recession could hit, a new competitor could emerge, a key technology could become obsolete, your main supplier could go out of business. By systematically thinking through all the potential failure points, you can then ask a second question. Is the current price or structure of this deal providing me with enough of a buffer to survive one or more of these things going wrong? This pre-mortem analysis forces you to confront risks head-on and immunizes you against optimistic overconfidence. The second application is the redundancy principle, a concept borrowed from engineering. An engineer building a bridge doesn't design it to hold the exact weight of the expected traffic. They design it to hold 3 or 4 times that weight. They build in a margin of safety through redundancy. In business strategy, this means not relying on a single customer, a single product, or a single supplier. It means maintaining a fortress-like balance sheet with more cash than you think you need. It means building an anti-fragile system that doesn't just survive shocks, but can potentially get stronger from them. For an individual's financial planning, it means having a robust emergency fund, avoiding excessive debt, and insuring against catastrophic risks. Finally, for investors, the blueprint can be simplified into a practical rule of thumb, the 50% discount rule. After you have conservatively estimated the intrinsic value of a business that is firmly within your circle of competence, you simply wait. You do not buy until Mr. Market, in one of his fits of despair, offers it to you for 50 cents on the dollar, or close to it. This requires immense patience. You may go months or even years without finding such an opportunity, but it ensures that when you do act, you are doing so with the wind so strongly at your back that it is hard to fail. This is not market timing, it is opportunity hunting. The path of the 99% is the polar opposite of this cautious, resilient approach. It is the path of the leveraged gambler, the person who structures their financial life to optimize for the best-case scenario with no buffer for error. They run their business on a razor's edge of debt, believing that rosy economic forecasts will last forever. They buy stocks on margin, borrowing money to amplify their bets, believing that a rising market will never fall. They are chasing returns without any thought to the risk they are taking on. The most spectacular example of this folly is the story of long-term capital management, or LTCM, in 1998. The firm was a hedge fund run by some of the most brilliant minds in finance, including 2 Nobel Prize-winning economists. They had developed incredibly complex quantitative models that they believed had unlocked the secrets of the market. They made thousands of trades, betting on tiny pricing discrepancies, and used staggering amounts of leverage, borrowing over 30 times their capital, to magnify their small gains into huge profits. For a few years, it worked brilliantly. They were hailed as geniuses. But their models had a fatal flaw. They were built on historical data that did not account for a true black swan event. They had no margin of safety. When Russia defaulted on its debt in 1998, a shockwave of panic hit the global financial system, causing their carefully calibrated models to break down completely. Because they were so highly leveraged, their losses were catastrophic. The firm lost over $4.6 billion in less than 4 months, and was on the brink of a default so large that the Federal Reserve had to orchestrate a massive bailout to prevent it from taking down the entire global financial system. LTCM was the ultimate antithesis of the margin of safety. It was a monument to the arrogance of prediction and the catastrophic danger of having no room for error. The direct financial connection of the margin of safety is perhaps the most tangible of all Buffett's principles. It is expressed in the strength and flexibility of a balance sheet. For a corporation, a large margin of safety means low debt, high cash reserves, and diversified, predictable revenue streams. For an individual, it means a high savings rate, minimal consumer debt, and a portfolio that is not dependent on leverage. This financial structure is not just defensive, it is a weapon of offense. When a crisis hits, like the 2008 financial crisis, companies and individuals with no margin of safety are forced into survival mode. They have to sell assets at fire sale prices just to stay afloat. But the entity with a strong balance sheet, the one with a margin of safety, can do the opposite. They can step into the panic and deploy their capital. This is exactly what Berkshire Hathaway did in the fall of 2008. While other institutions were collapsing, Buffett was able to invest billions of dollars into iconic companies like Goldman Sachs and General Electric on incredibly favorable terms. He was acting as a lender of last resort, not because he could predict when the crisis would end, but because his decades-long adherence to the margin of safety principle had given him the financial firepower to act decisively when others were paralyzed by fear. That ability to not only survive a storm, but to emerge from it stronger than ever, is the ultimate financial reward for building a buffer against an unknowable future. So you have your circle of competence, your anchor of intrinsic value, and your margin of safety. You have a defensive framework. But how do you go on offense? How do you select the specific investments or business strategies that are most likely to thrive over the long term, regardless of the economic weather? This brings us to the fourth and perhaps most elegant pillar of Buffett's philosophy, the wonderful business filter. This is the culmination of his evolution as an investor, a shift from just buying cheap things to buying wonderful things. Instead of trying to predict the unpredictable twists and turns of the economy, this principle focuses on identifying businesses with such powerful, durable competitive advantages that their success becomes nearly inevitable. It's about betting on certainties, not maybes. The story of this transformation centers on a box of chocolates. In 1972, Warren Buffett and Charlie Munger were presented with an opportunity to buy a company called See's Candies. At the time, Buffett was still operating primarily under the influence of his mentor, Ben Graham, as a cigar butt investor. He looked for mediocre businesses trading at dirt-cheap prices, hoping to get one last puff of profit out of them before they were discarded. See's Candies was different. It was not statistically cheap. It was a high-quality, beloved brand on the West Coast, known for its old-fashioned stores and premium chocolates. The owners wanted $30 million for it, but Buffett's calculation of its tangible assets, its factories and inventory, was only about $8 million. His cigar butt instincts told him to walk away. But Charlie Munger saw something else. He saw the power of an intangible asset, the brand. He saw a business that had a deep, emotional connection with its customers. For decades, people had been giving See's Candies as gifts for Christmas, Valentine's Day, and birthdays. It was a part of family traditions. This deep-seated loyalty gave See's something extraordinary: pricing power. Every year, the company could raise the price of its chocolates, and customers would barely notice. They weren't just buying candy. They were buying nostalgia, quality, and the certainty of a good gift. Munger convinced Buffett that it was better to pay a fair price for a wonderful business like See's than a wonderful price for a fair business. They ended up buying the company for $25 million. It was a pivotal moment in Buffett's career. See's Candies would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway over the subsequent decades. And it did so while requiring very little additional capital investment. It was a cash-generating machine. It taught Buffett that the best way to deal with an unpredictable future is to own a business so strong that it can weather any storm. A recession might come, but people would still buy chocolates for their loved ones. Inflation might rise, but See's could raise its prices to match. The lesson was clear: stop trying to predict the macroeconomic environment and start focusing on the microeconomic reality of an unassailable business model. The underlying psychological principle at play here is the immense power of human habit and the status quo bias. We are creatures of routine. We tend to stick with what we know and what we've done before. A wonderful business leverages these deep-seated psychological tendencies to create a protective barrier, what Buffett calls an economic moat. Think about the brands you use without even thinking. You might ask for a Coke rather than a cola. You might pay for something with your Visa or American Express card without considering alternative payment networks. These are not just business transactions. They are ingrained habits. This creates a level of demand predictability that is almost impervious to economic forecasting. The CEO of Coca-Cola doesn't need to have a strong opinion on next year's GDP growth to know that billions of people around the world will still want a refreshing sweet beverage. The moat protects the business from the winds of the broader economy. It creates a private stream of profits that flows consistently, year after year. By focusing his analysis on identifying these moats, Buffett shifts the game from one of uncertain prediction to one of identifying existing, durable patterns of human behavior. He's not betting on the future, he's betting on the continuation of a proven past. To apply this as a mental model, you can use Buffett's economic moat checklist to analyze any business, whether as an investment or as your own venture. There are 4 primary types of moats. The first is intangible assets. This includes powerful brands, like See's or Apple, that command pricing power and customer loyalty. It also includes patents, which give a company a legal monopoly for a period of time, or regulatory licenses that are difficult for competitors to obtain. The second moat is high switching costs. This exists when it is expensive, time-consuming, or risky for a customer to switch from your product to a competitor's. Think of the software that runs a large corporation's accounting system, or the bank where you have all your accounts and automatic payments set up. The hassle of switching keeps customers locked in, even if a competitor offers a slightly better price. This is a core part of a sustainable business strategy. The third moat is the network effect. This is a powerful dynamic where a service becomes more valuable to each user as more people use it. The classic examples are credit card networks like Visa and MasterCard. The more merchants that accept Visa, the more useful it is for cardholders. And the more cardholders who have Visa, the more essential it is for merchants to accept it. This creates a virtuous cycle that is incredibly difficult for a new competitor to break into. The fourth and final moat is a cost advantage. This can come from immense scale, like Costco or Walmart, which can buy goods cheaper than anyone else and pass the savings on to customers. Or it can come from a unique process or geographical advantage that allows a company to produce its product or service at a structurally lower cost than its rivals, like Geico's direct-to-consumer insurance model. Using this checklist as a filter for your long-term investing or entrepreneurial efforts forces you to prioritize resilience and durability over fleeting growth stories. It's a framework for finding certainty in business fundamentals, not in economic trends. The antithesis of the wonderful business is the commodity business, the trap that ensnares the 99%. A commodity business is one that sells a product or service with no real differentiation from its competitors. The only thing that matters to the customer is price. Think of most airlines, steel mills, or textile manufacturers. They are locked in a brutal, never-ending price war. Their profitability is entirely at the mercy of the economic cycle. When the economy is booming, they might make a small profit, but when a recession hits, demand plummets, and they are often plunged into devastating losses and bankruptcies. Buffett himself famously called the airline industry a, quote, death trap for investors, for this very reason. For decades, the industry has consumed vast amounts of capital to buy new planes, only to destroy that capital through vicious price competition. An executive in a commodity business lives and dies by economic forecasting. They have to guess the future price of fuel, the future demand for travel, and the future capacity decisions of their dozens of competitors. It is a terrible, low-margin, and highly unpredictable game. The 99% are often drawn to these businesses because their stocks can be highly volatile, offering the illusion of quick profits. But over the long term, they are capital-destroying machines, the very opposite of the ever-widening moat of a wonderful business. The direct financial connection of this principle is revealed in two key metrics: return on invested capital (ROIC) and free cash flow. A wonderful business with a wide moat consistently generates a high return on the capital it employs. A company like See's Candies or Coca-Cola doesn't need to build massive new factories every year to grow. Their growth comes from their brand and pricing power, which requires very little new investment. As a result, they gush free cash flow, the money left over after all expenses and investments. This cash can then be used to pay dividends, buy back stock, or acquire other businesses. A company like this is a financial gusher, a true engine of wealth building. In stark contrast, a commodity business, like an airline, is a capital furnace. It has to constantly spend enormous sums on new airplanes, just to stay competitive. It has a very low ROIC, and it rarely generates significant free cash flow over a full economic cycle. On a balance sheet, the difference is night and day. Berkshire Hathaway's portfolio of wonderful businesses provides it with a steady, predictable, and ever-growing stream of cash that it can then reinvest. This is the mathematical secret to compounding. By filtering for wonderful businesses, you are not just buying a stock. You are acquiring a financial engine that will work for you, in good times and bad, for decades to come, providing the foundation for true financial freedom. We have now assembled a powerful analytical toolkit. We have a rule for staying within our intellectual limits, a method for anchoring our decisions in value, a defensive strategy to protect against error, and a filter for identifying uniquely resilient businesses. But there is one final pillar, one that governs the application of all the others. It is the master principle, the one Buffett believes is most responsible for his success. It has nothing to do with finance, accounting, or economics. It's the understanding that in the game of investing and high-stakes decision-making, temperament is more important than intellect. Even the most brilliant strategy is useless if you lack the emotional fortitude to execute it under pressure. This final pillar is about building an emotional fortress to protect yourself from the single greatest threat to your long-term success: you. The scene is the fall of 2008. The global financial system was in a state of cardiac arrest. Lehman Brothers had just collapsed, triggering a wave of panic not seen since the Great Depression. The stock market was in a terrifying freefall. The world's largest insurance company, AIG, had been bailed out. The credit markets were frozen solid. Every television screen was filled with images of shell-shocked traders and headlines predicting a complete economic meltdown. The prevailing market prediction was not just for a recession, but for a systemic collapse. Fear was no longer an emotion, it was the atmosphere. In this moment of absolute terror, Warren Buffett did something extraordinary. He was calm. While the rest of the world was selling everything that wasn't nailed down, Buffett was on the phone, looking for things to buy. He was not just calm. He was actively, publicly optimistic. On October 16, 2008, in the very heart of the storm, he published an op-ed in the New York Times with a simple, powerful title, "Buy American, I Am." In the article, he laid out his thinking with perfect clarity. He acknowledged the dire headlines and the pervasive fear. He flatly stated, "The financial world is a mess." But then he made a crucial distinction. He explained that a bad short-term economic forecast does not invalidate a good long-term investment case. He wrote, "In the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts, the Depression, a dozen or so recessions and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet the Dow rose from 66 to 11,497. His message was simple: fear is the investor's enemy. Bad news is the investor's best friend. He announced that he was moving his personal cash reserves out of safe U.S. Treasury bills and into American stocks. And his actions backed up his words. During that period of peak panic, Berkshire Hathaway made massive, life-saving investments in iconic American companies like Goldman Sachs and General Electric, securing preferential terms that would generate billions in profits for years to come. He was the living embodiment of his most famous maxim: be fearful when others are greedy, and greedy only when others are fearful. This was not an intellectual feat, it was a temperamental one. His IQ was no higher in 2008 than it was in 2007. What set him apart was his ability to keep his head while all about him were losing theirs. The psychological principles at work here are the twin beasts of herd mentality and the fear and greed cycle. Humans are social animals. We are wired for conformity. For most of our evolutionary history, sticking with the tribe meant survival, while wandering off alone meant death. This ancient instinct manifests in modern financial markets as herd behavior. When we see everyone else selling, our brain screams at us to do the same. This is driven by a powerful psychological phenomenon known as social proof. We assume that if everyone is doing something, it must be the right thing to do. During a market crash, this creates a terrifying feedback loop. Selling begets more selling, driving prices lower, which creates more fear, which triggers even more selling. This is the neuroscience of a panic. Your amygdala, the fear center of your brain, takes over, releasing stress hormones and shutting down the rational, analytical part of your brain, the prefrontal cortex. You are no longer making a calculated financial decision. You are a scared animal trying to flee a predator. The greed cycle is the same process in reverse. When markets are soaring and everyone is bragging about their profits, the fear of missing out, FOMO, kicks in, overriding our better judgment and causing us to buy assets at inflated prices. Buffett's entire career is a testament to his ability to short-circuit this primal destructive emotional cycle. His temperament acts as a firewall between the market's manic emotions and his own decision-making process. This is the ultimate application of behavioral finance. How, then, can a regular person build this kind of emotional fortress? It requires creating a personal operating system, a set of predefined rules and mental models that you follow regardless of your emotional state. The first tool is the pre-mortem analysis. Before you make any significant investment or business decision, you perform a thought experiment. Imagine it is 1 year in the future, and your decision has failed spectacularly. It has been a complete disaster. Now write the story of why it failed. What went wrong? Did a recession hit? Did a competitor outmaneuver you? Did you misjudge the market? This process of proactively embracing the negative possibilities does two things. First, it often reveals risks you hadn't previously considered, allowing you to improve your plan. Second, it psychologically inoculates you against future bad news. When something inevitably does go wrong, you won't be shocked or panicked because you've already visited that dark future in your mind and have a framework for understanding it. A second incredibly practical tool, especially for personal finance, is the automated investment plan. This involves setting up automatic, recurring contributions from your paycheck into a diversified, low-cost portfolio like an S&P 500 index fund. This simple act is profoundly powerful because it removes the decision-making process from the emotional arena. You are no longer asking yourself, "Is now a good time to invest?" based on the latest scary headline. The decision is already made. The system runs on autopilot. Whether the market is up or down, you continue to buy, a strategy known as dollar-cost averaging. This is a behavioral hack that forces you to buy more shares when prices are low and fewer shares when prices are high, the exact opposite of what your fear and greed instincts tell you to do. A third, more radical tool is the news blackout. This is the practice of deliberately and systematically ignoring daily stock market commentary, financial news channels, and expert predictions. Buffett has often said he could run his business just fine if the stock market were closed for a year at a time. The daily squiggles of the market are noise, not signal. They are a reflection of Mr. Market's mood, not the underlying value of your businesses. By tuning out the noise, you can focus on what actually matters, the long-term performance of the businesses you own, which is best assessed by reading their quarterly and annual reports. This is a difficult but transformative act of executive decision-making, choosing what information you allow into your mind. The antithesis to this disciplined temperament is the all-too-common story of the panic seller and the FOMO buyer. This person's entire financial life is a whipsaw of emotional reactions to the news. Let's follow their journey through the 2008 crisis. In 2007, seeing their friends get rich in the housing and stock markets, they are overcome with greed and FOMO. They take out a large mortgage and pile their savings into the market near its peak. When the crash begins in 2008, their greed quickly turns to fear. Every day, the news is worse. Their portfolio is bleeding value. Their friends are panicking. The experts on TV are predicting Armageddon. Finally, unable to take the pain any longer, they sell everything near the bottom of the market in early 2009, locking in a 50% loss and vowing never to invest again. They have sold at the point of maximum pessimism. Then, they sit on the sidelines in cash for years, watching in a mixture of disbelief and regret as the market begins a long, steady recovery. By 2013 or 2014, with the market hitting new highs, the old feeling of FOMO returns. They can't stand to miss out any longer. They finally get back in, buying back the same assets they sold, but now at a much higher price. They have perfectly executed the strategy of buying high and selling low. Their portfolio is not a reflection of a rational investment strategy, but a painful diary of their emotional state. This destructive behavior has a direct and quantifiable financial cost, a phenomenon known as the behavior gap. Studies by financial research firms like Morningstar have consistently shown that the average investor's actual returns are significantly lower than the reported returns of the mutual funds they invest in. For example, over a 10-year period, a fund might have an average annual return of 8%, but the average investor in that same fund might only have a return of 6%. That 2% gap is the behavior gap. It is the wealth that is destroyed by bad timing, by pulling money out during panics and piling in during manias. It is the direct financial cost of a poor temperament. Over a lifetime of investing, this gap can amount to hundreds of thousands or even millions of dollars in lost wealth. Warren Buffett's superior temperament doesn't just protect him from losses. It allows him to capture the full return of his investments and then some, by using the emotional mistakes of others as his opportunities. His emotional fortress is not just a defensive wall, it is a money-making machine, the final, crucial component in a system designed to achieve financial success in a world where no one knows the future. You have just been given a powerful and timeless mental arsenal. You have absorbed the 5 pillars of a philosophy that has built one of the world's greatest fortunes, a system designed not to outsmart the future, but to be so fundamentally sound that it doesn't need to. You now understand the critical importance of staying within your circle of competence, of anchoring your decisions to intrinsic value, of demanding a margin of safety in all things, of filtering for wonderful businesses with impenetrable moats, and most importantly, of mastering your own temperament. You now possess the blueprint for the unsinkable ship, a way to navigate the chaotic waters of finance and business with a sense of calm, clarity, and purpose, liberating yourself forever from the anxiety-inducing noise of market prediction. But it is crucial to understand that what you have just learned is one powerful network of ideas within a much larger system of thought. Warren Buffett's mind is a latticework of interconnected mental models. The principle of ignoring the future is a cornerstone, but it is supported by and connected to other equally powerful frameworks. Mastering this one piece has given you a tremendous advantage, but the true power comes when you begin to link these concepts together. There is another, equally critical mental model that Buffett uses, a tool that acts as the keystone, locking this entire anti-forecasting structure into place. It's a method for cutting through immense complexity in any business or investment decision to find the one or two variables that truly matter. The video that is now appearing on your screen is not just another piece of content, it is the missing link, it is the next piece of the map. It is the tool that connects the what to do, the principles you've just learned, with the how to focus in a world of overwhelming information. It takes this broad philosophy and sharpens it into a razor's edge for practical, real-world application. Think of what you've learned today as building the engine. The next step is learning how to steer. The choice you face now is a simple one, but it is a reflection of a deeper identity. Amateurs in any field are defined by their distraction. They chase noise, they react to headlines, they are swayed by the predictions of others. Professionals are defined by their focus. They operate on timeless principles, they ignore the noise, and they concentrate only on the few things that truly drive results. The journey to becoming a professional in the art of decision-making is a continuous one. The next step on that path is right there, on the screen. The choice to continue your ascent, to complete your mental arsenal, is yours.